In this video, we're going to discuss the basics of lease accounting. So lease accounting changed dramatically in 2016 when we had a new accounting standard for US GAAP. I'm going to talk about that, but before we get into it, I want to make sure you understand the basics and understand what a lease is. So a lease is just a contract by which one party, which we'll call the lessor, grants the right to use property or services to another party, which we call the lessee. Okay, so the lessor is basically renting something to the lessee. So if you think about an apartment, the tenant, so the person renting an apartment, if you're renting an apartment, you're the tenant. So the tenant would be the lessee, and then the landlord, so the person that owns the apartment building or the company that owns it and they're renting to the tenant, that is the lessor. So we've got the landlord is the lessor, and then the tenant is the lessee. So I want to get a little bit more into how we've changed accounting now with the new lease accounting standard. So it used to be that there were two types of leases. There were leases that were capitalized, and there were leases that were not capitalized by the lessee. And by capitalized, remember we talk about whether something is brought on the balance sheet and made an asset. Okay, so are we going to recognize an asset? And the reason that this is a big deal is we're saying, hey, we're renting something here. So let's say it's a machine, for example. Let's say that your company is renting a machine, and you're saying, hey, should I recognize an asset? Should I recognize this machine as an asset? And then also, what about the lease payments, right? So let's say it's a 20-year lease where you're going to be making payments for 20 years on this machine to the lessor. So should you say, hey, I've got an asset here, I'm going to book that on my balance sheet, and then I'm going to have a liability for 20 years of lease payments? Used to be the case that it was a significant source of off-balance sheet financing where companies would structure leases in such a way that it was not considered an asset, and therefore they didn't have any liability for the lease payments. But that changed dramatically in 2016. Now, all leases that are longer than 1 year in length, so if it's a 2-year lease, 3-year, 30-year, 40-year, it must be capitalized. That means that the lessee is going to recognize an asset. So you can call it a right of use asset because they've got the right to use this machine or the apartment building or whatever. So they're going to recognize an asset. And then they're also going to recognize a corresponding liability for the lease payments, because they're saying, hey, look, for 20 years or 2 years or 3 years, we've entered into this agreement and we've got to make these payments. And so that's going to be a liability that's going to go on the balance sheet, right? So it's going to make the company look like it has more debt. It's going to look more leveraged. And that's why companies didn't want that for so many years. They used to like being able to say, hey, we've got this machine, or we'll structure the lease agreement in such a way this is not going to appear on our balance sheet. We'll keep that debt. We'll keep the liabilities off our balance sheet. Now they don't have that option. If the lease has more than 1 year in length, you have to capitalize the lease. Now, that being said, even though we've changed it now where we say, okay, if it's more than 1 year, it has to be a capital lease, we still have a situation where we have to classify the lease. The lessee has to determine, okay, is this a finance lease or is it an operating lease? And the basic idea behind what we're trying to figure out is, has control or ownership of the asset been effectively transferred to the lessee? If it has, then we call it a finance lease. If it has not, then it'd be an operating lease. Now, it's a little more technical. This is just a basic concept. What we actually do is we say, okay, look, if the lease is cancelable, and then we look at these 5 different tests, which I'll discuss in another video. You know, one of them is ownership of the asset transferred to the lessee at the end of the lease, and so forth. So we have these different tests. If any one of those tests is met, then it has to be recorded as a finance lease. I'll have an entire video where I'll talk about the difference in accounting between finance and operating leases. But for right now, make sure you understand that whether it's a finance lease or operating lease, if it's more than 1 year in length, we're going to be capitalizing it. So that doesn't change, whether it's finance or whether it's operating a lease. In each case, we're going to recognize a right of use asset and we're going to recognize a liability for the lease payments. So that's not different. There are some different income statement effects, whether we're going to recognize interest expense and so forth. I will talk about that in a video to come. But for right now, just make sure you understand there's an asset and a liability with each type of lease. Now, the lessor is actually going to look at these same 5 tests, because the lessor, when the lessor is doing their books, they have to figure, well, how do we classify the lease? Okay, so they're going to do the same 5 tests, and they're going to determine, okay, is it an operating lease, or in terms of the counterpart to a finance lease, it's commonly called a sales type lease. Okay, so it'll be a sales type lease or an operating lease from the lessor's perspective. The reason that some people call it a sales type lease instead of saying, oh, it's a finance lease, is there's actually a third classification that a lessor could have. It could have something called a direct financing lease. That's not as common. I'll talk about that more in a video to come. So I just want to leave you with another thing is you might be wondering, well, who are these lessors? You can think if you rent an apartment building, you know who a landlord is. But in general, when we're talking about companies leasing items or property, who are they leasing from? Who are the lessors that are leasing these items to the lessees? And the most common thing that we would have would be a bank, right? So banks are actually the most common type of lessor, but we also have something called captive leasing companies. A captive leasing company would be, let's say that you decided you wanted to buy a car, right? So you go over and you decide you want to buy a certain type of car, and the manufacturer of that car will actually provide financing, right? So you want to buy the car and you can get actually financing from the manufacturer. So let's say it's Ford or something like that, right? So a lot of companies, they have their own financing that they do, and they call it captive because you're buying the car from them. So it's like they already have the customer there at point of sale. And so captive leasing companies are actually also a common type of lessor. And then the third type of lessor that you see is we have independent leasing companies. That's a company, that's all they do is structure lease agreements. So they're not a bank. They're not selling you an item and then offering you financing. They're just a company that's all they do is specialize in leasing items and creating lease agreements.